Hello. In this video, we'll talk about loss limitations with respect to partners in a partnership and whether they can actually deduct the losses. And the other topic will be allocation of liabilities to determine each partner's outside adjusted basis. So first, let's talk about loss limitations. Now, I have a few other videos that talk specifically about at-risk rules and passive activity loss limitations. I strongly recommend watching those videos that talk about the intricacies of each rule, why the rules matter, and whatnot, and the specific law with respect to those rules. Let's just talk about, in general, how it all plays together, the loss puzzle, I call it, how it all fits together with respect to a partner in a partnership. So limitations apply to losses incurred by partnership and properly allocate to partner under Section 704B. So we've talked about the rules with respect to how to allocate income, losses, credits, deductions, whatnot from a partner to a partner, from a partnership to a partner. The next question becomes, okay, once the loss has been properly allocated to a respective partner, can it actually be taken? And there's three rules that generally must be followed. And of course, there's individual rules that also must be followed as well once you go at the actual individual partner view. So these three rules we're going to go through briefly. The first is Section 704D, which says the use of loss is limited to the partner's outside basis. So, for example, let's say that there's $100 of loss allocated to a respective partner through the 704B allocations, and a partner only has a $75 adjusted basis, outside adjusted basis in the partnership. Well, the partner cannot take all $100 of the loss because the partner is limited to the amount of the outside basis, which is the $75. So $25 of that loss will carry over to the next year, where we look at the basis and see if it goes up or goes down for income, for contributions, and whatnot. All right, so once we go through the Section 704D limitation that says that losses are limited to the outside basis, the next step down the process, or waterfall if you will, or whatnot, is to consider the Section 465 at-risk limitations. All right. Now again, I have another video on the Section 465 at-risk limitations. I strongly recommend looking at that, but that's the next stop. And the idea is that we're looking at certain types of financing, or what exactly are you at risk? What do you have your skin in the game with respect to your investment? Okay. And then finally, the last step is the passive activity loss limitations under Section 469. And that has to do with the type of activity, whether it's active, whether it's passive, whether it's investment activity. Again, I have another video on that. Now, these are not the only three tax rules that say whether a partner can actually deduct it on his or her 1040 or whatnot, or if it's a corporate partner, the 1120. You have to look at other rules that might be with respect to the specific partner, but these generally must be looked at for any partner when you're talking about a partnership to a partner. So that's all I really want to talk about when it comes to the limitations with respect to losses that are allocated. Again, consider the at-risk limitation videos as well as the passive activity loss limitation videos, because they will go in further detail. So one thing I want to highlight and talk about is you have to look at the individual limits in addition to these. And one individual limit that goes after this discussion is from the Tax Cuts and Jobs Act of 2017. There's a new rule that applies to 2018 onward, for tax years 2018 or onward, and it says that excess business losses cannot be deducted in the current year, and they have to be carried over as a NOL. Now, an excess business loss is defined. You look at the business entity, the actual activities of the business entity. You look at the aggregate deductions when they exceed the aggregate income, again, from the business entity, plus $500,000 if you're married filing joint, or $250,000 for all other taxpayers. $250,000 for all other taxpayers. So really what this is doing is it's saying you can deduct the amount of deductions up to aggregate income plus $500,000 if you're married filing joint, or $250,000 if you're married filing separate. Because beyond that, it's going to be suspended. It's going to be carried over to next year under the NOL rules. So really what this is it really only allows, after 2018 onward, it only allows deductions of losses from these types of activities, these business activities, of $500,000 if you're married filing joint, up to $500,000, or up to $250,000 if you're anyone else. So up to that amount, and anything beyond that is considered carries over to the next year. And you have to continue that analysis and keep going and keep going. It can offset income. So if you have, $3 million of a loss one year, you can only take $500,000, and then you have $2.5 million. But the next year you have $3 million in income. You can use that $2.5 million to offset all of it next year. So that's really how it works. You apply the just like the NOL rules. But if you do have a business that does generate a lot of losses year to year to year to year, then it's possible that it's going to take a long time to recoup those that loss. And before the Tax Cuts and Jobs Act, there was no kind of limitation like this. So this does put a huge restriction on the ability of pass-through entities like S corporations and LLCs, and even sole proprietorships, flow-through entities, to get a benefit over C corporations, because the loss was trapped in the actual C corporation and it would have to flow over through the NOL rules. All right, so that's really important to understand, is that there's this new item here, and it does put a severe limitation on partnerships, LLCs, which is what we're talking about here, and it also applies to S corporations and others. So let's continue with our discussion. Now, the main part of this discussion is about liabilities. So if you recall, in a previous video, I talked about how on formation and contribution, a partner will be allocated part of the partnership's liabilities in the outside adjusted basis. So it's all about the partner's outside adjusted basis, computing that. Now, you might recall seeing the partnership balance sheet and how we separate the capital accounts and the actual amount of the liability. But the partner, when calculating the outside adjusted basis with respect to partnerships, anything that applies to subchapter K, we actually add in a portion of the partner's share of those liabilities to the outside adjusted basis when we're doing all different types of calculations later on. So this goes to our section 705 calculation of every year we look at the, we recalculate the partner's adjusted basis, the outside adjusted basis. So recalculate the partner's outside adjusted basis. So every year we have to worry about liabilities and the effect of things. You just simply don't do it upon formation or contribution with respect to, or whenever a partnership takes on liability. You have to do it every year. So that's key. We have to do this every year. Okay? Every year. And that's why this is part of section 705 in a way, because we're looking at the outside adjusted basis. Okay? So if you recall from that contribution formation video, we said that section 752A basically says that when a partner takes on a liability, it's viewed as an increase in the partner's share of liabilities. They're treated as a contribution of money. But when a partner is relieved of liability, it's treated as a distribution of money. So we talked about that from the previous videos. Okay? So the question becomes, specifically with this 752A, the partner's share of liabilities. Partner's share of liabilities. And that's where we're really getting into. And it also affects the partner's share of liabilities with respect to a decrease as well. So it's both of these. It's both the increase and decrease, but we're really going to focus on the increase when we talk today, but it also equally applies to partner's share of liabilities that decrease. How do we determine a partner's share of liabilities? Okay? Well, until the early 1980s, we really had to look at, and we still do look at, whether it's recourse versus non-recourse. But it was a lot easier. So if you recall, we talked about recourse versus non-recourse financing many times in many videos, specifically in the non-recourse deduction video for allocations. We talked about what recourse versus non-recourse is. Just again, a simple explanation. And again, you can watch those previous videos for more detail. But recourse, you are personally liable for that liability, meaning that you can go after, the creditor can go after personal assets. Non-recourse, though, is just limited to the investment in the actual partnership. It's kind of like limited liability versus unlimited liability. Similar concept. It's not exactly the same, but you can think of it like that for a very basic understanding. So until the early 1980s, so this was the old rule, okay? And you're going to see that this still somewhat is applicable. Until the early 1980s, it was a very simple rule. And that very simple rule was that if it was recourse financing, we simply, the partner share of liabilities, okay, let's say a partnership buys property and they borrow money from a bank. The way that we would allocate that partner share of liabilities, we would look at the loss ratio. We would look at the loss ratio, how partners share losses. For non-recourse, we would look at the profit ratio. Okay? And why exactly does this why do we use loss for recourse and profit for non-recourse? Well, if you think about it economically, let's say you're a partner in a partnership, and let's take non-recourse. You are not personally liable for guaranteeing a loan, going beyond your investment. Well, let's say a partnership buys a piece of property for $100,000. Okay? They buy it for $100,000. And they borrow all $100,000. They borrow all of it on a non-recourse basis. And let's say the partnership uses as collateral that property they purchased. So it's the property they purchased is secured, secures the mortgage. Okay? Let's say the value of this property, let's say it's real property, it drastically decreases. The market tanks. Let's say the value goes from $100,000 to $40,000. Well, and this all happens, let's say, in 1 year. Well, it's very likely that the partnership is going to foreclose or default. They're not going to pay on their liability. Because remember, the loan was secured by the property. So if they don't pay, then the bank takes the property, and that's all that happens. Okay, they takes the property, and that's all that happens. The bank can't go after the partnership, the actual owners, for more than just that. It can go after that property, it can seize the property and take that, but that's really all there is. So in doing that, under the non-recourse, okay, if it's non-recourse, then the partners don't really lose. Now, think about it. What happens if that same piece of property, okay, again, partnership purchases for $100,000, it's secured by the $100,000 property, it's a $100,000 mortgage. Let's say in a year, the market drastically goes up and it goes up to $200,000. Do you think that the partnership is going to stop paying on that loan? No, they're going to continue paying. So we use profit ratio because, generally speaking, economically, when a partnership is doing well, the partnership and the partners will continue paying off those non-recourse loans. But if it does bad, it a lot of times will default. Now, obviously, there's other things to consider, like credit rating and all that stuff, but we're just talking about economically. For recourse liabilities, the reason that we use the loss ratio is because think of that same example. Think of that same example. When the property went down in value from $100,000 and then a year later went down to $40,000, if it was a recourse liability, guess who has to actually bear the risk of that? The partners. So it's upon the loss is when the partners actually have to go, this creditor can go after the actual partners, okay? Versus if the property goes up in value and things are going well, the partnership, they have lots of money to pay for that, okay? So the idea is that if the value of the property goes down and the partnership goes belly up, then the creditors can go after the individual partners, so we look at the losses. So this is the old rule. It was that simple. But things have gotten a lot more complex, and this rule there was lots of holes in this rule. Now, I will say that this rule, still consider this rule because many times this rule still holds muster. It still works, okay? Not always, but many times it does, Okay, so if you're, sitting at a cocktail meeting, cocktail conversation, we call it in tax, and someone asks you, how exactly do I allocate as a partner in a partnership or a member of an LLC? How do I actually take on, what is my share of a non-recourse debt or a recourse debt? Just use this general rule. It really does work. You could obviously condition it, well, in special circumstances, it's a more detailed analysis, but this is really what you think of. Okay, now that being said, you need to know the proper application. And that's very, very, very important. Okay, and it's in the regulations under section 752 regulations. So the first thing, I'm going to give you the full analysis of the new rule. Okay, again, you can use this old rule to help guide you in your understanding, but the new rule, that's how you're going to have to do things. So the first thing that we need to consider is whether we actually have a liability that under the regulations. Now, the regulations in 752 actually distinguish two types of liabilities. The first type of liability is called a section 1.752-1 liability, and the other type is a 1.752-7 liability. Now, the first type of liability is really what we think of when we think of a liability as if you've taken like business or accounting. It's a liability where the obligation that's created creates or increases the basis directly or indirectly, or gives rise to a deduction, or gives rise to the expenditures described in section 705. Okay, so really it's just a plain vanilla liability like we think. Taking on a mortgage, where it creates certain deductions, interest, non-recourse, whatever it is. Certain types of deductions. So it's really the key for understanding whether it's a 1.752-1 liability, which is the one that we're going to talk about, is it's a normal liability where it's fixed. You know that there's a legal obligation. So legal obligation is the key. So again, of the two types of liabilities, the main type, there is an actual fixed legal obligation that's created. The second type of liability, which is the Reg 1.752-7 liability, deals with contingent liabilities, and we're not going to focus on those because those are very, very, very difficult. They're beyond the scope of this discussion. Very difficult topic. I would recommend going to a treatise, McKee, which is the WG&L treatise for partnerships, to look at the contingent liabilities. So we're just talking about a legal fixed obligation liability, a plain vanilla what you think of when we think of a liability. All right? Okay. So really, the central part when it comes to determining what kind, how exactly to look at liabilities, and this phrase is very important. I definitely would write this down. It's the economic risk of loss. The economic risk of loss. This is what the regulations harp on. And really the regulations under 1.752-1, they basically define a recourse liability as a liability that some partner or related person to the partner or partnership bears the economic risk of loss, versus a non-recourse liability, no partner or related person to the partner or partnership bears the economic risk of loss. That is the distinguishing point. Well, what exactly does that mean? Okay? Well, the economic risk of loss concept really serves two essential purposes. First, it's used to characterize a liability as recourse or non-recourse, as we just mentioned. So if the economic risk of loss associated with a liability is borne by one or more persons of the partner or related persons to the partners, then the liability is recourse. But if not, then it's non-recourse, which we mentioned. Second, we use the economic risk of loss to determine the share of the recourse or non-recourse liability. So what are some examples where the economic risk of loss happens? Okay, well, we're talking about, so how can we have economic risk of loss? And there's more types out there. I'm just giving you some of the more basic understandings of these. So we're talking about things like under state law. So if you're a general partner in a partnership, okay, and you have all the plain vanilla rules under state law, then that requires you to go to a certain point when it comes to making up for certain issues, certain liabilities. Okay. Another thing is that if a partner guarantees, okay, a liability or whatnot. Also, securing certain property. So if certain property is secured, then that's considered economic risk of loss. So the partnership itself can bear the economic risk of loss up to a certain point by securing certain property, which makes it recourse to a certain extent. So it could actually be partial. So if you don't, and these are just some of the big ones. So state law, this should be state law. Let me erase this. Okay. So if state law, again, creates some type of obligation that a partner must make up to a certain, deficit restoration or whatnot, that creates economic risk of loss. And then guarantee, that partner could say, oh, even though they're a limited partner, they might guarantee up to a certain extent, and then the partnership might secure certain property or whatnot. And that's a huge thing. So that's what we look at when we look at economic risk of loss. So if you don't have economic risk of loss, no partner or related partners, then it's considered non-recourse. Non-recourse. All right? So if it's considered a recourse liability, then we basically use what we call an end-of-world liquidation test. End-of-world liquidation test. And the reason it's an end-of-world liquidation test is because you're going to see that some assets are going to be sold for $0. That's the key. For zero. I know it sounds crazy, right? End-of-world liquidation test. All right. So the partner share of recourse liability is a portion for which a partner has the economic risk of loss. The partner has economic risk of loss if obligated to make payment in constructive liquidation and not entitled to reimbursement. So that's key. There cannot be any reimbursement allowed. It's going to be that partner has to bear the risk of that item. So the way we do the constructive liquidation is that we assume that all assets are sold for zero. So the partnership, all assets, liabilities become due and full, payable in full. All partnership assets, including cash, become worthless, so they are sold for zero. Not fair market value or anything, just zero. You have to sell them for zero. So basically, every asset has a loss for its book value, if you will. All partnership assets are disposed of, and then we have gains or losses, which are allocated. So the next step is we allocate gains or losses, and we do that according to our allocation rules, right, which we've already learned. Allocation rules, okay? And then the partnership liquidates and liabilities are paid in full, okay? That's what this all assumes. And at the end of the day, you look at the partner's capital accounts. And in terms of the deficit restoration, it's what partners have to make up what. Now, if a limited partnership, that's more difficult, right? Because you're looking, if you have all limited partners, then they don't have to go to a certain extent. So we're going to talk about that would be a non-recourse liability. But if you have a limited partnership where one's a general partner, well, then the general partner is going to get up to beyond that amount. So you got to really apply the rules that we've learned back in the allocation, and that's the key, is that those allocation rules, those are very important, okay? So at the end of the day, we look at the partner's capital accounts at the last step, upon liquidation. Upon liquidation, that's the key. And that's saying, okay, well, this is how the liability is broken up. Now, there's a guarantee by a partner, and that partner is required because there's a separate agreement on the side. Well, guess what? That creates, even if the partner is a limited partner under state law, they're not required to go beyond a certain amount. But that guarantee is a separate contract, if you will, that says that they have to do something. Okay? So a few special circumstances I want to talk about. Obviously, if you're told that a liability is fully recourse, you simply just do this analysis. Okay? If it's fully recourse. If there's no, if there's this, if one of the partners personally guarantees the partnership obligation, then up to that amount is going to be considered. You have to obviously take into account all of these items, but when you do that guarantee in the end, right, for that liability, you have to take that into account, and that becomes economic risk of loss to that partner. Now, one thing that's important is whenever you have a guarantee, we always assume that the parties that agree to the guarantee will live up to their obligations regardless of what actually happens to them, regardless of their net worth. So we just assume that everything will be met. So assume everything holds true. That's very important. Assume all true. All events will hold true. You might be, okay, well, how can this partner, how can this partner agree to personally guarantee a certain amount when we know they don't have enough money? We later on. Well, we still assume that it's all true, okay? Unless you're told, oh, that's irrelevant or something. But, okay, so don't worry. Just assume that it's going to be held true. Now, if it's a non-recourse liability, again, based on that non-recourse determination, we have separate rules. Okay, we have separate rules. And we'll go to that next. But the last thing I want to mention is that if we have property that's secured, so I talked in the previous slide about property secured. To the extent that property is secured, it's recourse to that amount. So it's recourse to that amount. Beyond the amount, it's considered non-recourse. So it's like a partial amount. It's like partially recourse, partially non-recourse. That's very important to understand. Okay? So now, finally, we're at non-recourse liability. So this is when no partners have economic risk of loss. So a perfect example would be if you have like a limited liability, an LLC, a limited liability company, where no partners expected to go beyond a certain amount, right, in their investment, and there's no guarantees, there's no securing of property, right, all that good stuff. Well, you apply the non-recourse liabilities because nobody bears the economic risk of loss beyond a certain point. So this is a three-tier waterfall. You have to go down the waterfall, and we have to recall certain allocation rules that we learned before in previous videos. So number 1 and number 2 come from the allocation rules, our special allocation rules. So first, we allocate the non-recourse liability based on the partnership minimum gain. So this comes from the NRD rules, right? That was Reg 1.704-2. Next, we allocate based on Section 704C gain as if the property were sold for the debt. And that comes from the 704C rules, which is Reg 1.704-3. So those were 2 of the special allocation rules that we learned. Finally, the last part is that we allocate according to profits interest. So we see, hey, there it is again, the old rule, our good friend, the profits interest that we talked about on the previous slide, right? Remember the old rule, non-recourse, we allocate based on profit. That comes into play again. So whatever is left beyond allocating the first 2 steps of the waterfall, we allocate according to profits interest. Now that's the default. Okay, we allocate according to profits interest. You can also allocate alternatively using a reasonably expected share of deductions attributable to non-recourse debt. So that's that non-recourse NRD rule. Remember we learned about that when we were talking about Reg 1.704-2. Go back to that. We talked about that range. Right? Remember that range? That's the same idea from the Reg 1.704-2. So the default rule is the profits interest. Now there's a third rule, a third option for this number 3, but it's very rare. So there's a rare option which deals with the Section 704C allocation rules. Okay, I wouldn't really worry about that because almost never that one happens. It's almost always the profits interest or the NRD allocations. Now, if the agreement does not specify, it's going to be the default, unless the partners do want the NRD, and then it must be specified. So this one must be specified. The NRD must be specified that you want that. If you don't have that, then the partnership's going to come in, it's going to apply the default rule. So this really concludes how we allocate non-recourse liabilities, the general idea. Now, I strongly recommend going and looking at some examples on how this takes place. Once you go through examples for recourse and non-recourse allocation of liabilities, trust me, it really will help you understand.